Hello, everyone. Thank you so much for joining us for our next quarterly webinar. My name is Jeremy Kronemeyer. I'm an operations manager for Wickham Financial Group, and I will be your host for today's call. Our presenters today will be Graham Wickham, who's president and CEO of Wickham Financial and Insurance Services. And Graham will be handling some of the market updates and some considerations for that. And then we have Jennifer Smalley, who is an investment advisor and one of our newest team members here at the firm. The presenters will take about 15 to 20 minutes to go through the slides here and go over their sections. And then at the end of the call, we'll have a Q&A section time at the end. If you have any questions, on the right side, you should have a Q&A box where you can put some questions in there. So during the call, you can type those in there, and then we'll try to get to those at the end. And then if you have any questions, just please let us know. And Graham, I'll let you take it away.
Yeah, thank you, Jeremy. Thanks for all the team being on the call. Thanks for our listeners and viewers jumping on the call. I'm going to cover really market updates, some year-end, and then Jennifer is going to take over on the year-end tax planning tips. Kind of some things that we kind of just need to be mindful of as we approach the end of the year. But I'm going to go ahead and address kind of where we're at in 2025. Maybe do a little bit of a comparison to 2024. And then kind of leave you with some thoughts and considerations to wrap up this year, since we're really only a couple months out. So if we look at 2025, kind of year to date, and we'll look at the returns and some comparisons, really the leader this year from an indices standpoint has been that NASDAQ. That NASDAQ is that technology-driven index. That's really been the leading sectors. Not to put the cart before the horse when I get to that slide, but it's up about 18.5% roughly for 2025. If we look at the S&P 500, think about the S&P 500 is really that index that probably most of us are going to follow. It's 11 different sectors that track the U.S. economy from small to large, mostly large, and close to about 30% of that index is really technology driven, with about 7 to 10 companies making up that 30%. It's up about just over 16.5%. Now, what's really stepped up this year, which has been a laggard in previous years, has been the Russell 2000s. That's that small cap index. Those are companies maybe a little smaller in capitalization size than like the Microsofts or NVIDIAs, which are $4 and $5 trillion. These are much smaller companies. They've really taken the lead here, or really been some big gainers here in the last couple months of about just under 14%. Then if we look at the Dow Jones Industrial, and that's about a 30 stock index, tries to cover, a swath, if you might, of the U.S. economy in terms of the sectors, but it's 30 stocks, generally tends to be a little more value-based, that blue chip, if you might, when you hear that term. It's only up just under 10%. So it's really been the laggard. We've really seen the growth side of the market, that tech side of the market, really being the leaders, where the value is still lagged a bit year to date. If we look at international, that's been what's really stepped up. If we look at the MSCI ACWI, now that basically just covers developed international, ex-US, and emerging markets. So everything international, not the United States, of 26.7%. And that hasn't been the leader for decades now. But boy, has that come on strong. So that's really, I think, been the surprise. Not complete surprise. We were kind of making a call that this year might be the year for the laggards for 24, 23 to really step up and broaden out from an indices standpoint. And that's exactly what we're seeing. We're seeing a broadening out with small mid caps playing a role in the overall performance, not just large cap tech, even though they've had a great year, and then international coming on board. And look at this, bonds boring, but still a diversifier for your portfolio. If we just pulled up kind of widely followed indices or an ETF from iShares Core US Aggregate Bonds. You can think about this. You got equities and stocks, bonds, IOUs, debt. They're up 7.47% if we're throwing in the income that they're spending off well. So that's been a good performer this year. All in all, we've had some really good performance in those respective indices. And I threw in here, what is the growth of the United States from a GDP standpoint, gross domestic product? How are we performing? Well, in 2025, we're probably projected to be in the year moderating a bit in our growth. Somewhere we're seeing projections about 1.7 to about 2, just over 2%. But if we looked at the Q2 2025 GDP, I was coming in pretty strong at about 3.8%. So we're projecting that this will moderate a bit as we're seeing with what the Fed's doing with lowering interest rates and a moderation in the economic growth. But again, this is to be expected, not really a surprise. Now, if we look at the annual performance comparison, how have we done from 24 to 25? I think it's been pretty interesting. When we look at 24, really the NASDAQ was that big leader. We ended 2024, it was up over 30%. Now, I know we're not done with 25 yet, and we're up about 18%. Then it was followed by the S&P 500. If we look at growth, that was really kind of been slowing a bit in 25, so it hasn't been the biggest, even though the NASDAQ's up 18%, the S&P's following that, so on and so forth. But we're just seeing that broadening out that I talked about, and then those small caps, mid cap area have really stepped up, not to leave out international. So we're kind of comparing from a chart standpoint. We look at 25 being in the red, if you might, 24 being in the blue. Yeah, we're still under, if you might, 24 returns. Again, we still got a couple months left, so anything could happen, positive or negative. But what's really been the one leader this year compared to 24 is that small cap area. It's really stepped up, and the appetite for that, since it's been a laggard for so long. And we've been kind of really waiting for that. In a diversified portfolio, that international bonds has consistently been underperformer compared to that S&P, NASDAQ-driven large cap tech. So it's nice to see this market broaden out. That really lends to a healthier environment. And I think that's generally where we're at. Now, again, just kind of refortifying what has been the leaders, that tech area. If we look at the best performers to 2025, it's been that tech stock area, up just under 25%, capital goods 20, followed by U.S. discretionary 15, utilities. Utilities have really stepped up. They've been that boring side for years, but think about this, utilities, technology, AI, the areas to facilitate that, need energy, and that's where sides of the utility sector have really stepped up. Also keep in mind, and we didn't include this, not every side of healthcare has been an outperformer. Pharma has been an underperformer, or certain sides of healthcare have been an outperformer, but generally up about 12% odd. Same with the utilities, consumer non-cyclical, up about 10, almost 11%. Then we get into the worst performing sectors. Conglomerates, covering multiple sectors, off about 4. Transportation barely up for the year. Energy just ticked up, but that's been a real underperformer. Financials, now I would say financials have actually lagged, say, technology, but certain sides like conglomerates or the large financials like a JP Morgan, Citigroup, Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley, the mergers, acquisitions, large money centers have really been tremendous outperformance this year, and I would put them up into that best performer camp. But we're just kind of looking at a sector in general, not the subsectors or sub-industries. So if we look at basic materials, up about 8, and services up about 9%. So you can see really what's been the leader, the laggards so far this year. If we kind of look at kind of an economic overview with some fourth quarter forecast, kind of what's leading this. Well, if we think about inflation, so inflation is cost of goods and services. You want to deal with it or not, you go to the grocery store, you fill your car up with gas, you get your energy bill, that's inflation, right? We have also self-imposed inflation, meaning we might pay more for certain things. But in general, we're seeing inflation so far, right around 3%. It's been moderating down from 24 and 25, kind of ticked down from the beginning of the year, kind of ticked back up a little bit. We were concerned that maybe inflation with the tariff talks and Negotiations might tick up a little higher, but it seems like it's moderating around that 3 area. Now, it might still have a little bit more room to tick up. We'll just have to see, or maybe it ticks down a little bit as we approach the end of the year. But as comparison to 22, going all the way back to 22, remember, we were around 9% inflation. We've gone from 9 all the way down to 3. But the Federal Reserve, if you know what I mean by that, that's the Federal Open Market Committee. That is really mandated with jobs and price stability in the U.S. economy. That's their role, to kind of keep that in check. They have it mandated too. So they would like to see inflation come down. But my opinion is, for whatever it's worth, I think we're doing pretty darn good at 3, because having a little bit of not overheating, and 3% is not, to have a little bit higher inflation above 2 just means it's an economy where consumers are still willing to spend. And that's not all bad, because that's leading into positive earnings. And I'll get into that in a second. If we look at the unemployment rate, it's really been steady Eddie. It's been around 4.3%, and that's relatively low. Now, do we think that's going to kind of move up? We do. We do think that has an opportunity to move up. You know, it's not necessarily that the unemployment rate's going to increase. That's always a concern, but I think we got room to go before we need to be concerned. But it might be the pace of that increase that might change the picture a little bit and spook the Federal Reserve or spook the markets. But right now, we're at about 4.3. We probably think that's going to edge up just a bit. Now let's get into earnings. Earnings right now, on average in history, so as we look at the earnings beat ratio, or that percentage beat, it's been about 75%. We're looking at 24, about 71% of the companies beat earnings expectations. To date in 25, we're at 75%, and it's forecasted to be about 78. That's very healthy. That means we're in a good economy. People are spending money on goods and services, and it's flowing through to the bottom line for companies, and that's coming through with earnings beat. That's what you want to see for a market to continue to hopefully justify these higher multiples. And keep in mind that the long-term average is about 75. So we're at trend year to date. We're looking to be above trend a little bit, at least forecasted by the end of the year. We'll see where we end up here. So in conclusion, kind of some thoughts and some considerations. You know, I would look at a strong returns that's led this market with good earnings. We've had a good economy, even though we do feel it's going to moderate a little bit. You know, we can't keep hitting at such a high level without the market overheating. So we do think we're seeing some moderation. That's to be expected. That's what we're calling for. We don't think anything's going to fall off a cliff. So kind of what do we think is going to happen? We think the market's going to continue to broaden out. The leaders will still be good, but maybe we'll get a catch up from the laggard groups, the underperformers, where maybe the earnings are okay, maybe not as strong, but we got room for their multiples to increase and our stock prices to move up. Overall, we would just say stay diversified. It's been the winning strategy this year. We are seeing portfolios in general with lower risk profiles outperforming, at least on a risk-adjusted basis. And we do think that's going to continue. So kind of how we think about it here, diversify has been working. We think that's going to continue to be the model for success going forward, even though we might still have periods of outperformance during certain times. So that being said, that kind of wraps up my portion, and I'd like to turn this over to Jennifer Smalley, who is going to kind of cover some end-of-the-year tax planning tips, maybe some timing things we want to think about as we move towards the end of the year. Jennifer?
All right. Thank you, Graham.
You got it.
We got some new legislation in July this year, so some of that's in here. Certainly, your situation is different than anyone else's, so happy to have that individual conversation with anyone. One way to make the most of your tax bracket this year is to maximize those retirement contributions. The limits are here, so $7,000 to an IRA, $8,000 if you're over 50 years old. And we can put a lot more, obviously, in the 401k for those who are still working and have access to that. There are different catch-up provisions if you're over 50. And also, they carved out a few years ago an additional catch-up provision beyond that for those ages 60 to 63. As a reminder, you have to have earned income to contribute, and anything you put in a pre-tax or traditional will give you a break on your taxes this year. Anything you put in a Roth will not, but obviously will grow after tax. So again, happy to have that conversation about which one is right for you. If you're self-employed, you have some additional options like a SEP or a simple. And then, putting into that pre-tax will reduce your taxable income, and you can save a lot this year. So we can talk about whether you should save this year or whether we want to be saving in taxes in future years, or some of both. Another consideration for year end is to accelerate your charitable giving. We can deduct up to 60% of our AGI if we are giving in cash or checks, and up to 30% of our non-cash donations. So that is one way to reduce your taxable income. There will be some limits from that new legislation I mentioned for 2026. Again, very, very specific, but we can talk through whether it makes more sense to go ahead and make those donations in 2025 or whether 2026 is still good for you. For those who are age 70 and a half or older, you have the option to donate from your IRA using a qualified charitable distribution. Now, you can gift up to $108,000 a year that way and not report that as income. So you don't actually have to bring it through your bracket. You can just gift that directly to that charity. Another option for those that want a little more flexibility in their giving could be a donor advised fund. Now, the benefit of that is you set up the fund, and you go ahead and make that contribution, let's say in 2025, you get the deduction for it in the current year, but you don't necessarily have to send that gift out in the current year. So for those who might have a higher income year, maybe you make the donation now, and then you spend the next couple of years actually distributing to those organizations that are important to you. Another consideration for year end is managing those capital gains and losses. And obviously, Graham's investment strategies help us all to do that. And some ways that we can do that include tax loss harvesting. Maybe there's some things that have been underperforming. I mean, he covered the different sectors, and some are up and some are not as exciting as we would like for them to be. So maybe this is a time to, in the next couple of months, look through what are we holding and why? Do we still like where it's headed? And is it time to maybe sell out of some of those underperformers and reposition from a tax perspective and invest in something else if we're looking for some growth from those? If we do have some losses, we can deduct up to $3,000 a year to offset income. So and anything beyond that, we're able to carry forward to future tax returns. So again, just a good opportunity to review that portfolio and see if it's time to make some strategic moves there. One other consideration, we do still have a couple of months. So if you do still have earned income, or if you have Social Security income, this is a good time to check your current withholding. Maybe get an estimate on how much you have paid in federal and state tax so far this year. Ours is a pay-as-you-go system, and the IRS really likes to get their money throughout the year. Cash is king, right? So cash flow is important to them, and they want us to be paying every month and every quarter throughout the year, rather than just making a large payment in March or April as we're doing our taxes. If you're not sure where you stand, there is an estimator on the IRS website, and it can help you estimate your income for the year. And once you've done that, how much tax might be associated with it. And so if you are still working, you might go ahead and adjust that W-4 as we get closer to the end of the year. Even small changes will help you sort of catch up and not be caught off guard when you're doing your return in the spring. For those who have 1099 income, meaning non-W-2 income, or other sources, pensions, annuities, that type of thing, it might make sense to do estimated quarterly tax payments for you. We're getting towards the end of the year, but there is still time to catch up a little of that, and also to make sure that we're planning for what that could look like for 2026. And that'll help you avoid some penalties there. One consideration, again, as we get close to year end, is do you have a large traditional IRA that might need to be moving over to a Roth, and you can do some small strategic amounts over a period of time. We generally don't recommend converting the whole thing all at once. But, is this a lower income year for you? Are you maybe transitioning into retirement? And so you only have a portion of the earned income you used to have. Is it a lower bonus year? Whatever those factors are for you. Is there some reason this year might have less taxable income? And you say, well, I could go ahead and move some from that traditional to the Roth and incur the tax bill for it this year. It does get reported as income on your tax return. So you would owe tax on that in this current year. But as you see there, the long-term benefit is you've got tax-free growth in the future. So once it's in that Roth bucket, it is growing without that tax burden. Gives you a lot more flexibility over withdrawals and the timing of when to pay tax. Again, the strategic advantage there, if you are in a higher tax bracket, expect to be in a higher tax bracket during retirement, this could be a good time to go ahead and do that. Often we think we're paying more tax when we're in these high income earning years, but by the time we factor in the required distributions from the IRAs and Social Security and any pensions and other distributions, we may actually still be in a higher tax bracket than we would expect during retirement. So happy to help people answer any questions around that. That kind of wraps us up with our tax topic. I know that was a lot all at once. We do have just a few items for a checklist. If you're thinking, well, what should I be doing? Take a look at where you are on those retirement contributions. See if it makes sense to throw a little more in there this year if your cash flow allows. Look at those itemized deductions if you are one who is still itemizing at this point, and make those charitable deductions, those donations before the end of the year. It's got to be in by December 31st to count. And again, reposition some things from a harvest loss perspective. Couple other things I want to throw in there really quick. If you are still working or pre-Medicare age, you can contribute to a health savings account. So that could be a way to save some on tax for this year. And just another reminder, if you're already at required minimum distribution age, so 73 and above, go ahead and make sure that you are getting those dollars out of the IRA before the end of the year.
Excellent.
At this point, I'm going to turn it back over to Jeremy. We're going to see what questions have come in from the team.
Thank you, Graham. Thank you, Jennifer, for doing that. We did have some questions that come in. Graham, for you, we've had recently that some of the larger companies have had some large layoffs here. What does that tell you?
Well, maybe not a lot outside of maybe things are just moderating a little bit. Maybe the realization of AI and the productivity from AI is now flowing maybe in the to the bottom line, and these companies are realizing they don't need all the employees that they brought on during the pandemic, and this is their opportunity to kind of downsize a little bit. Overall, do we feel like the unemployment rate is probably going to increase, like I mentioned earlier? Yeah, we do feel it's going to increase a little bit, but it's not necessarily the fact that just unemployment is increasing. Sometimes the bigger concern would be the pace of increase. So we think it can be moderated, maybe with an aging nation, aging population. Maybe it's less going back into the workforce. Maybe that can be absorbed with some that are coming out, or if we're creating and trying to build up maybe some of our energy industries, maybe some of that workforce that's coming off, it can flow over to some other areas. So I think it's a little bit of maybe just a moderation with the over-hiring and the opportunity for productivity from AI. We're not overly concerned, but we're keeping our eye on it.
Gotcha. Well, then, a lot of the meetings we've been having lately, Graham, where, people are, is the market really overdone? Are we setting up for a pullback here, going into the end of the year, first of the year?
Well, I think you always got to expect it. I'm probably a super politician when I always make the general statement that we could get a 5-10% correction at any time, right? Someone could hiccup, there's a tweet, there's some geopolitical event that shocks the market. And when you trade at valuations that we're trading at, which aren't crazy by any stretch, but they're lofty in general. Some sectors are a lot more bubblicious than others, if you might. which are not trading at lofty valuations. So it's not the whole market as a whole, but generally where the S&P is trading at, it's not inexpensive. So I think it does set us up for some events or just a situation where the market uses an event to take profits. And I think you just have to expect for volatility. You know, one thing that I've thrown out from time to time is that we've had 56 different corrections since 1929. Think about that. They're not uncommon. We'll get about 22 corrections. And think about a correction of somewhere between 10 but less than 20%. We might get 34 corrections, or excuse me, 22 bear markets, 34 corrections, bear market 20% or more. We might get 34 corrections, 10%, but less than 20%. So they're not uncommon to have. And I would often say that, you know, we don't have to like them, but maybe we should welcome them, because what they do is they take the over enthusiasm in the market down a little bit. It gives the market kind of opportunity to kind of stair step, where we have moments of pause to reflect, and the market has an opportunity to pull back a little bit so we can set ourselves up on that next gear up. Not every correction is 2007-8, where, you know, we're down 50%, or the first of the year down 20%. Those are definitely much more unusual than just a garden variety 5-10%, even a 1-2-3%. So expect it. We're probably going into a period of a little bit more volatility, even though the market looks pretty good coming into the year.
Gotcha. Well, speaking of that, going in, you know, we're about a month into earnings here. Do you see, with all the big tech players kind of coming out this week and then next week, what do you see kind of earnings kind of finishing up for this quarter?
Yeah, we're actually seeing great earnings, and that's been the theme. And that's why the market can also support these higher multiples. As long as earnings are there and people are spending money and so on and so forth, yeah, you can support these higher multiples. It's when that starts faltering that we got to worry about the valuation we're trading at. But I think we're seeing earnings coming in at about 15%. We were expecting somewhere between 10 to 12. So that's great. Where we're seeing revenue growth of around 8. So very good earnings so far in general. So we're expecting that that's going to hold up.
Gotcha. Well, Graham, I think that's all the questions I had. And thank you to our listeners, and thank you to the people that come in and check in with us on our quarterly webinars. And if there was anything during this presentation that you had questions about, or you wanted to set up another meeting, just contact anyone here at the team, and we'd be glad to get with you and set up a time to have a phone call or an in-person meeting. And we look forward to seeing you guys next time.
Yeah. Thank you.